Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Andrew Martin Smith, manager of the Guinness AIM EIS. Hello, Andrew.
Good morning, Alex.
First off, can you just tell me a bit about Guinness and give me an introduction to yourself and experience?
Certainly. Guinness Asset Management is an active, long-only fund manager which was started in 2003 by Tim Guinness. The firm manages funds both for individuals and institutional clients, and in 2010, as a result of its expertise in the energy sector, it branched into managing EIS funds investing in renewable energy. Since that time, the rules have changed a bit and we have a much broader investment remit on our EIS schemes. My background is in traditional merchant banking. I started as an asset manager for Hambros Bank, worked in the corporate finance and capital markets for a period of years and went back into fund management in 1993. And I've been involved in and around the funds management business since that time.
The Guinness AIM EIS, what does it do for investors?
The AIM EIS fund gives investors a spread of investments which qualify for EIS tax reliefs when they're looking to public markets for money. What it gives is access to pretty much whole of market. And there are very few places in which you can get that. The reason for that is that a lot of people who run EIS schemes, whether they be stockbrokers or other small investment banks, will be looking mainly at their own product, whereas our fund is completely independent of any other activity, and we see most of those stocks that are going to be listed on AIM.
And why should I invest in, say, an AIM EIS rather than a more general EIS without the restrictions of having to invest in AIM?
The reason for that really would be taste in one way. There's no reason why there's nothing necessarily better than one. But I think that the AIM companies are liable to be more seasoned than some of the general EIS businesses, which are probably at an earlier stage. They may not be, but they can be. AIM stocks will have qualified for a public listing, therefore they will be more liquid. And in a general AIM EIS investment, it may be many years before you can realise that investment if it's successful or if it fails, really. But in AIM, you will, after three and a half years, there should be a liquid market for that stock, and so you should be able to realise your investment.
And it's quite risky, isn't it, AIM? You've got EIS and AIM put together. Is it very, very risky?
It can be. I mean, if you like, the smaller end of the stock markets tend to be more volatile than the higher end, and that's certainly the case. But also there can be greater opportunities in smaller stocks than in larger ones. AIM has certainly got a bad reputation in some areas because it has been used by a lot of stocks which have, particularly in the mining resources area, which have tended to be quite volatile. However, I would say there are over 900 stocks on AIM. Some companies in AIM are some of the best in the world. We have another product which we use on AIM where we can justify our investments in these stocks because they match up to some of the best companies in the world. Now, the ones where we're at AIM and EIS, which is your real point, yes, you're right. These are companies which tend to be more speculative, but it depends how good their business plans are, how realistic they are, and that's my job to really understand whether these business plans are realisable and whether some are, are very easy to understand, some less so.
And do you get many opportunities each year to invest?
Yes, we log this quite carefully. I mean, it will depend from year to year as to how the stock markets are and how receptive they are to new issues, and whether there are lots of external factors as to how many stocks we get. But probably in a year we might see between 60 and 70 issues, some of which may not come to the market, but we'll see them. They may fail for different reasons. But that's quite a good spread.
And typically, how many would you invest in?
As we went along, we found it better to have a bigger spread, so somewhere between 15 and 20 20 odd stocks, perhaps a few more, depending on what's going on.
So can you give a few examples of recent investments you've made?
Yes, delighted to. A good example would be Creo Medical. This is a business which makes medical devices for surgical endoscopy, and has very interesting prospects. They've recently raised a second placing of over £40 million on AIM, and this is a business which we believe has very good prospects. Another business we've invested in, which IPO'd in the summer, is a business called Trackwise, which made printed circuit board technology for the automotive and aerospace industry. That was a business which was floated in order to allow the company to invest in a new factory and to get some liquidity for the principals. Those are two very interesting businesses. We also invested in several software and information technology businesses, such as iNexus, which provides software for management, and Maestrano, which provides services to the software services for the financial services industry.
And typically, when you invest, when are you going to get out?
Our holding period, in order to qualify for the capital gains tax free period, is 3 years. We invest throughout a year, so we raise the money in April and we invest it throughout the year. So we may take investments up until March of that year, which means that we have to hold it for 3 years from that March. But 3 years is the principal period, and then it's a question of when is the right time to sell, and that's a judgment which we make. It depends very much how the stock's performed. Very often in the AIM market, there is quite limited liquidity if the stock hasn't been very high profile, and therefore we'll probably have to wait for some news in order that there be some sort of activity around that stock.
And will you ever sell before the 3-year period? Yes,
we will occasionally. We won't if it would be very unlikely for us to spot a stock that's going to fall in time to sell it. But when a stock rises a great deal and we think that it's unsustainable, there is a point at which we may say, well, this is ridiculous, and we perhaps should take some money off the table. It's happened a couple of times. One was in an oil and gas stock called Angus Energy, where it went up really very sharply. In fact, before we'd got the EIS 3 certificate, so we sold a bit. And another company is Way Education, where we invested at 3p, and at one stage it was over 40p, and we decided to take a bit of a profit there. It's quite a nuisance for our investors because it then messes up their tax returns and brings a tax-free investment within their tax base. So it's something we would prefer not to do, but on the other hand, if it's been that successful, it's not that painful.
Yeah. And how has of course past performance isn't a guide to the future, but no. How has performance been in your previous portfolios? Have you exited any of the portfolios completely at this stage?
Our first fund was in 2014, so we've been exiting that last year. We have returned 120p for every pound invested thus far, and we have one investment which is private, which we hope to sell at some stage soon, but at the moment it was an IPO which didn't happen. It's done extremely well, by the way. The company is fine, but there isn't a liquid market for the stock at the moment. So that's been quite a satisfactory investment. The next fund will probably be less successful in a way. I suspect we'll get. It's very difficult to predict, but at the moment I would say that we'll be seeing a profit on those, but it's difficult to tell you exactly what I would anticipate that entirely. And certainly over the last few months, it's been quite torrid in the markets. The more recent funds, too early to say really. Well, they're down a little. One of them's down a little bit. The other is about flat.
Well, you've obviously exited. Do you want to talk about some of the more successful exits you've had?
Yes, I think the exit I'm happiest to talk about is an exit we've made this year, actually, in the 2015 scheme, which is a company called Gear for Music, may be familiar with, which is an online retailer of musical instruments and services. And that's been a fantastic story. It's done extremely well both in the UK, consolidating its position here, and also in Europe. But when that came up for 3 years, we did exit that, and that was about 415% gain. So that was that. But that masks a few less satisfactory investments. A stock which is actually we exited out of the 2014 scheme, which we were sad to see go, really, in a way, was Chapel Down, which is the wine producer. Premier Technology Services, which is a buy and build contracting business, which has been extremely successful. That's another business we would like to have held on to. FairFX, which is a business which we invested in 2014 scheme and sold a couple of years ago sold a couple of years ago. We've reinvested in FairFX in the 2018 scheme. That's a very satisfactory. I think that's going to be a very successful business. Well, it already is a very successful business. So there's a flavour of a few.
It doesn't seem to be any particular sector. You're just looking for AIM, and are there any other common themes in the companies you'll look for? It's
very difficult to have. We're sector agnostic. We have to be, because we don't know what's going to be, which companies are going to be using the markets at any stage. I think there are things that we prefer not to invest in. I have a particular gaming businesses I'm not terribly keen on investing, and businesses which are using a London listing for reasons which are slightly opaque. Right. Some of the Far Eastern businesses have done that, and they're less easy for us to really get a handle on as to that. But otherwise, we are restricted to a certain extent by the fact that this market attracts businesses which can only have been going for 7 years to qualify. That means that some of the more steady, longer term businesses probably aren't big enough to come to the market within that period, so we won't see those. But businesses with more, with higher growth plans, be they in biopharma or IT or software, those tend to be the businesses which are using the markets more often. And so there has been, we have a few more life sciences businesses than other industries.
And do you invest in the portfolios yourself?
Yes, I'm invested in each of the portfolios.
As are other directors?
Yes, they have. Yes, I think at least some of the older ones. I think these are some of our staff probably don't necessarily have EIS portfolios yet. They have other priorities for their money, but the elder members of the team do certainly invest in it. Yeah. Good.
And if I'm going to put money into an EIS this year, just sort of give me an elevator pitch. Why should I invest with you?
We've been in the market for a period of time. We are seeing all of the opportunities. It would be very difficult for you to pick and choose AIM stocks to invest in, I think, on your own bat. We're offering you a managed exposure to one of the fastest growing areas of investment in this country, and the AIM market has been extremely successful as well as being quite volatile.
Andrew Martin Smith of the Guinness AIM EIS, thank you very much.
Great pleasure.